Welcome to the What to Watch video update. This is a video that I do once a week where I go through and I look at all of the different charts because I do a video each day. I do a weekly video. I do an intermarket analysis video. I do a thing that I call the deep dive video. Those are charts that I really didn't focus on all that much. And I take all of those charts and I put them together in this video to really hone in on what I'm watching for the upcoming week. We are setting all-time highs with the S&P, the Dow, the NASDAQ 100. Things are looking positive. We're possibly looking extreme positive, but that can happen when we are showing good momentum and really moving to the upside. But we're wondering, are we starting to top out and we'll begin to come back down? Or are we going to be able to go and set more new all-time highs going forward? As always, I'll go through a positive set of charts and explain what is looking to justify stocks going higher from here. And then I'll have a negative section where I go through some things that we need to keep an eye on that are kind of making things look a little more negative for the time being, at least different than what we've been seeing in the past. This is being prepared for Monday, May 20th. The first thing I go through are the positive charts. This is looking at sentiment. I use the CNN Money Fear Gauge, Fear and Greed Index. We did not get all the way down to 25, so we didn't have an extreme negative reading. As we were coming down in April, we were able to bottom and then start to go back up. And as we're going back up, we tend to ride that as sentiment is improving. When we start to look at using this as a contrarian indicator is when we get above 75. Now, just because we get above 75 doesn't mean we're going to turn and go the other way. We spent a lot of 2024 right around the 75 level before we finally broke lower. So we'll have to use some other charts to confirm if sentiment is actually turning negative. Then we also keep an eye on the VIX. I've been really honing in on this lately. We're seeing some potentially positive things here, but we're getting very low readings. That usually means the market is becoming complacent, and we can't go an awful lot lower than where we're at right now. But we can also stay here for a period of time as well. We look at the VIX on the line chart, and we're actually dropping below 12 now, both with the line chart and on the bar chart. So that's just showing that there's not a lot of fear in the market. We look at the VIX of the VIX, which is an indicator to see how the VIX is moving. And this is kind of interesting. We had been getting some really low readings with the VIX of the VIX. Now it's been starting to go back up, even though the VIX is coming back down. Then this is what Tom Bowley put together, and he works with stockcharts.com. He has another site called earningsbeats.com, and he has a free email newsletter that you can subscribe to. But he went back and he looked at what does this mean when the VIX gets very low? Because usually we go with the idea when the VIX is low, it's time to go. Well, yeah, at some point, but we can sit at these low levels for a long time. We dropped under 12, and this is a weekly chart of the VIX. And he went back and did some research. Now, the chart is up to date as of Friday, but these annualized returns, they go back to the end of 2023 when he actually did this research. When the VIX gets to a really low reading, that's when we see the highest annualized returns. When we get above 13, we still see positive annualized returns, but they're quite a bit less than when we're under 13. And when we get up under 20, about 17 to 20, we still see positive returns. When we start to turn negative is when the VIX goes above 20. And you can see we actually have a negative annualized return there. That just means there's a lot of fear in the market. When the VIX is really going up, that typically means stocks are going down. So we're in a pretty favorable time now. We just want to keep an eye on this, meaning that the backdrop, at least historically, has been positive when we see such a low VIX reading. Now, another very closely related indicator that we use to study sentiment is called the skew index, where the VIX is calculated using at the money options. Well, the skew index looks at out of the money options, and both of these try to project what is volatility likely to be like 30 days from now. Well, we do a measurement down here, and this is starting to come up. We're not up into this red area yet, We want to keep an eye on this to see if we do come up here. Now, the reason I have this on the positive side is we don't necessarily know what one of these high readings means. If you look at the arrows that I have here, sometimes that marked the top, sometimes it marked the bottom, other times it just marked a continuation. So we need other charts to give us the context of what we think will actually happen. Now, this can come up and then eventually drop back down, and it won't give us an extreme reading. We'll just be keeping an eye on this one now. Then we look at the advanced decline ratio, and we're looking pretty positive. We're above zero, both with the 19 and the 39-day exponential moving averages, even though they did tick down a bit in Friday's session. We're also looking good with the advanced decline line. We're setting a new high this past week with the S&P 500. We're breaking out based on price. We're also breaking out based on volume. We were seeing volume lagging behind a little bit. And even though volume is below average, and that's a concern, it is matching up with breaking out with what we've been seeing with price. We also look at the new highs, new lows. They did contract in Friday's session, but as we were going up and setting an all-time high, we were expanding with the new highs inside of the S&P 500. So our 5 period is going up and our 10 period is going up as well. So this is showing good internal strength. Accumulation distribution, we were just about on the moving average. Now we're starting to come back above it. The moving average itself is starting to turn up. And this is a smart money indicator, and it's also based on volume. So if we see this going up, that tends to be quite positive. And then a similar type of measurement is called the Chaikin money flow. This is looking better. It had been negative as we were going down. We saw some improvement, and it's continuing to go up. And the red line, which is a moving average, is also going up. We're looking at the start of a new trend here. A week ago when I did this video, we were below the moving average with the ADX. Now we're starting to turn up, and we're just a little bit above 20. So this is suggesting that we're now entering into a trending phase of the market. And we can tell that this is positive because the green line's on top, even though it came down slightly. And as long as we keep going up and we're above the moving average, that will suggest a strengthening trend. And as long as the green line is on top, that will suggest that the trend is positive. And we're keeping an eye on our double and triple exponential moving averages here based on 20 periods. We're above both of the lines, and both the lines are continuing to go up. So that's showing in the short term that things are really improving. And we look at a 50 period double and triple exponential moving average. We haven't seen the lines cross yet, but we're above both of these lines here, the blue one and the red one. The more we can stay above this and eventually see the red line cross above the blue line, the more positive it would be. If you go back to when we were really going higher, we saw where the red line, which is a triple exponential moving average, and it moves quicker. So if this can cross above, that would even help show that the intermediate term is turning more positive. We look at the stocks above their 20 period moving averages that are inside of the S&P. We fell back a little bit on Friday, but we're above 50 and showing that about 75% of all the stocks are in short-term uptrends. And then here's a study, and we're looking positive here too. We came down when we were falling in April, and we got to a reading under 10. And then not too long after that, we shot up and gave another reading above 70. If we look at other times when that's happened recently, we saw that happen about a year ago in March, where we had a negative reading, shot up, and then you can see what happened in the market after that. We had another one of these back in October, where this was a failed signal, where we came down below 10. We didn't get up to 70. We fell back, but we set a higher low with the indicator itself, where we were setting a lower low based on price. That's a classic positive divergence. And then right after that is when we shot up above 70, and then you can see what happened after that. It looks right now anyway that it could be more what happened a year ago, what is happening now. We didn't see a failed signal here. So we just are maintaining that the positive trend is still intact for at least right now. The stocks above their 50 period simple moving average, above 50 and going up, that's positive for the intermediate term. And then long intermediate term and short long term, I know it's crazy, but we're going up with our 100 period moving average. So that's still positive. And this is positive too. And we're starting to get to the point where 80% of the stocks inside the S&P are above their 200-day simple moving average. Now, we can go up and camp up here for a while. This is also when we start to take a little notice that maybe we're getting a little too extreme, but in a positive environment, we can hang out here for lengthy times. We want to keep an eye on all the different moving averages. Now, we're above these moving averages, and as we're going up, we're starting to see the shorter term moving averages cross back up above longer term moving averages, and that will just turn things even more positive. If we really start to fall, we'll be watching one of these moving averages to see if they end up providing some kind of support. This is a weekly chart of the parabolic SAR, and this is when I personally started to turn more positive. We were positive on the daily chart, but then a week ago, we saw a dot underneath on the weekly chart, so that was a confirmation, and then we ended up going up after that. Well, now, with the up week that we just saw, we're seeing another dot underneath, so this is remaining positive in the longer term. The S&P McClellan oscillator, we did get up above this 60 reading, which sometimes is an extreme positive reading. We've fallen down from that level a bit, but we're above zero. So when taken all together, this is still positive. Whenever the McClellan oscillator is above zero, that means that the summation index, whenever it's above zero, it's going up. Where the McClellan oscillator, this is more short to intermediate term. The summation index is more intermediate to even somewhat long term. And so we're going up based on price. We're going up based on volume. We're seeing a little bit of a lag here, which could end up being positive. Now, on one hand, we see where volume is not coming up to these previous highs, where price is not coming up to these previous highs, where volume is. But be warned, these are two completely different indicators here. The indicator on top is calculated one way. The indicator on the bottom is calculated a different way. So we may see some different results here. I just plot them on the same chart. But for right now, this is looking quite positive for the S&P and the intermediate to even somewhat long term. Then we look at the NYSE. We look at a broader measure of the market. We did decline, but we're still above zero. So when we look at our summation index for the NYSE based on price, we're going up, and we're also going up based on volume. So this is still looking positive a little bit longer term. The bullish percent index has been going up nicely and not necessarily giving us an extreme reading, at least yet. We're just slightly below 70. This measures the point and figure buy or sell signals inside of the S&P. That means when this is going up, there's a lot of buy signals that are being generated, and that is positive. And I like this indicator because it's not moving average based the way some of our other indicators and oscillators are. We compare that to the NYSE bullish percent index. This is also going up, not coming up to a really high reading, but the fact that it's above 50 and advancing is positive. And this is something that was negative a week ago. We were still below 50 with the NASDAQ 100 bullish percent index. Now we've been able to cross above 50, and we're looking more positive here as well. The advanced decline line studies that we look at are holding up quite well. We look at the NYSE common stock, the S&P, the mid caps, which are flattening out, and the small caps, which actually declined a little bit on Friday. What I look at mostly is, are we above these moving averages? And even when we have slight down days, are we holding up fairly well? And right now, we seem to be holding up. We look at the slope oscillator, which this is our shortest term and touchiest oscillator, because I have a number of different oscillators that I'll show you next. After getting extreme negative, crossing above its moving average, and then going up, this is still positive, but you can see it's starting to roll over a little bit here. I put this green line on here because sometimes this can mark an extreme positive reading, but we can stay up here for a while. We just want to keep an eye on this one. Here are all the oscillators. The slope oscillator that I just showed, that's the top one. I also have another short-term oscillator called the TSI, Trend Strength Index. And then I have three intermediate term oscillators, the MACD, the PMO, and the PPO. These continue to be positive. And then I have two long-term oscillators, the TRIX and the KST, and they're still looking positive, to suggest that on all the time frames that we look at here, momentum is still positive. We look at the vortex where, yeah, the green line's coming down, but it's still on top. So this is still positive. We look at the cumulative advanced decline line for the S&P based on price, where we're breaking out to new highs. We're also breaking out when we look at this measure based on volume as well. So that's looking good and confirming the breakout with price that we're seeing with the S&P itself. Large cap growth was down a little bit since hitting a new all-time high, but this is still looking really strong. We're above all the moving averages, and price is above all of them as well. And so this is still holding up for right now. Now, this is kind of interesting, and it's rather uncertain whether this should be positive or negative. Okay, we just went above 40,000 for the first time with the Dow. And I've been saying this in all the videos. When I first started in the early to mid 90s, they were wondering if we would ever get over 4,000. Now we're closing above 40,000. So yeah, stocks can go up. Now that's positive. The negative part of this chart is the transports continue to lag behind, but they've been doing that for quite a while. What's interesting is we're seeing utilities really breaking out, and this tends to be more of a defensive nature. This is what we saw at the end of 2021, where growth of values started to really underperform and actually turn negative. We saw things like utilities and staples start to get stronger, and then we went into a decline after that. And I'm going to address this a little bit more when we get to the negative side of things. Here's the QQQs. We're above the moving averages. We're seeing where the 20 period is coming back up. And if we continue to stay above these lines, this blue line may cross above the 50 period moving average, and that would turn things even more positive. Then we look at the NYSE cumulative advanced decline line. We're breaking out based on price. We're breaking out based on the advanced decline line down here as well. Now, this is cumulative, where the bottom one, this is more like a regular advanced decline line that we look at. This is another slightly calculated differently advanced decline line where we are showing some strength here as well. And that's more positive for the broader market. We look at the NYSE common stock for the advanced decline line going up here. That's also confirming things. And we also look at this based on volume. So we're seeing a lot of confirmation, not only within the S&P, but other indexes, and then across the broad market itself. Here's another confirmation. Total U.S. stock ETF, 2,651 stocks. We broke out and are just coming off of setting a new all-time high. The FANG index also recently set a new all-time high. The stocks also not a new all-time high, but they are showing some improvement. They're above their 50-day moving average and still in a longer-term uptrend. The tech sector, this was on the negative side a week ago because we were below the 50-day moving average. We've now been able to break above that, and we're now setting a new all-time high with the tech sector. And we look at the tech sector and compare it with 3 to 7 year bonds. We're breaking out up above this rainbow, and that's positive. And I've been really focusing on the relationship between stocks and bonds, and I have a number of charts to show you here. This is one relationship, the S&P to 3 to 7 year bonds. This is going up outside of the rainbow, suggesting that the market at least is anticipating that we will have a soft landing. That means that we will avoid going into a recession. That's what a hard landing would be. And then this is kind of reverse logic here. This looks at 3 to 7 year bonds compared with stocks. When this is going down, that means the bonds are underperforming. To say it another way, that means stocks are outperforming. We want to see this continue to decline if we're going to stay more positive with stocks. And then longer term, this is a weekly chart of the NASDAQ 100. We're getting well above this long-term trend line going back to 2009. Here's the ratio that I usually show about once a week now. This is the NASDAQ 100, which is growth. We compare it to the Dow, which is more value, even though there's some growth in there. And we came up to a really high reading. This was the dot-com boom back in 2000. This was the dot-com bust. Then it took us many, many years to get back up to the same ratio again. This was right at the end of 2021. And then we went into 2022. Well, we're coming back up, and we've been dancing around this high ratio again. Now, the perma bears look at this and just start salivating, saying, oh, look, we've hit this same ratio before. Everything's going to fall apart. But we've been saying this seeing this for about 6 to 8 months now, and we could actually break above this and set another high with this ratio that's even higher than what we've been seeing now. We want to watch this. This is longer term. It takes a while for this to develop, but if this really starts to fall, then we would turn more negative. This is a similar type of study where we take the QQQs, the NASDAQ 100 with small caps. We're not quite at this blue line yet, but we're not too far from it either, and we've been chopping more or less sideways. So to me, this is still looking more positive. The perma bears are just waiting for this to crumble and go down. We don't know if that's going to happen or not. Here's another newer chart because last weekend I ended up watching a few of the perma-bear videos out there, and they had a new chart here, and they were just licking their chops saying, okay, we hit the same ratio recently with what we hit back in 2000 between semiconductors and the Dow. Man, we're just going to fall apart. Everything's just going to go crazy. It's the end of the stock market as we know it. Well, we did start to fall, and we're not back up to this reading yet, but we have been bouncing back up. We'll see if we can go even a little bit higher with this ratio. Now, if it does turn and start to go down, then we would use confirmation to see if we're turning more negative. Then we look at the QQQs to the 3 to 7 year bonds. We were having a hard time getting above the rainbow. Now we're not having any problems anymore with this ratio as we're showing a lot of improvement. The broad market is also breaking out above the rainbow compared to 3 to 7 year bonds. We also have another broad market measure, the S&P 1500, also breaking out above the rainbow and showing some improvement. The Eurozone, now this is not an apples to apples comparison. These are European stocks compared with American bonds, but it just shows that Europe is looking solid too compared to American bonds. We want to keep an eye on the 10-year yield. It did go up in Friday's session. It's still below its 50-day moving average. What would be more advantageous in this environment is to see the 10-year yield continue to drop and eventually drop below its 200-day moving average. If it goes back up, that could pressure stocks, at least in the short term. And then here's another look at Dow theory, just in case you never saw that before. I thought I took this other chart out, but I guess I didn't. Now we look at the negative side of things. We're concerned about volume. This is a percentage volume oscillator. This just measures over a period of time. If this is going up, that means volume is increasing. If this is going down, that means volume is decreasing. And that's one concern that we've had, where this is a negative divergence, where we've been going up with the S&P, we've been dropping lower with this volume oscillator. And that is a classic negative divergence. Now, it doesn't seem to be a problem yet, but when you read books on technical analysis and when you study things, this is one of the first things you look at. You want to see an upward move with an increase of volume. That just shows there's more conviction. So we'll just keep an eye on this to see if things end up changing. This is also giving us a little bit of conflicting information. This is the Swenlin trading oscillator. This was looking pretty good as we were going up. Now it's starting to turn down based on price. And it ticked up a little bit on Friday, but it's been showing some weakness here based on volume. This is still positive since we're above zero, but the fact that this is going down with price and kind of sideways with volume, that's a little bit of a concern that we want to keep an eye on. Then last week, this was on the positive side. Now it's on the negative side. We're seeing the red line go above the blue line. This is an intraday chart of large cap growth versus large cap value. When the blue line is above, that tends to be more positive for the market. Well, now the red line's coming back above the blue line. Here's another measure looking at growth to value intraday for the S&P. We were showing some improvement here, but now we've been starting to go back down on an intraday basis. And we're not really seeing much of an improvement with our end of day charts. We look at small cap growth to value. Yeah, it went up, but it's not really showing any conviction. Mid-cap growth to value, yeah, it actually declined on Friday and is dropping below its 200-day moving average with this ratio. And we're not seeing all that much of an improvement with S&P growth to value. We're wondering if the climate is shifting a little bit because we're seeing stocks that are usually defensive doing well, and we're seeing growth stocks now underperforming. Now, this could always change and rectify itself, but for right now, based on what we can see, this is just something we want to watch. Here's another measure between growth and value. We came all the way down to the 250-day moving average with this ratio. We bounced up off of that. We got to the top end of the rainbow. Now we've been down inside the rainbow more. We want to see this go up out of the rainbow to show that growth is outperforming value. This is another area that's really lagging behind. I'm looking at the bottom chart. Discretionary to staples. We want to see this really breaking out. It's at best just going sideways, even though it's still in a longer-term uptrend. And here's some other growth to value ratios. The Qs to S&P, not really showing any strength now, actually showing weakness with discretionary to the S&P, and actually came down and just a little bit above the moving average when we look at large cap growth compared with large cap value. Here's another look at the large caps coming back down to the moving average. We're still under the moving average with the mid caps, just a little bit above the moving average with the small caps. But you can see all these moving it, well, for the mid caps and small caps, they're declining, where we're chopping more or less sideways with the large caps. And that's not what we were seeing when the market was really going up. We want to see these trends actually move up as well. We're also keeping an eye on this. Now, this has been showing some improvement with the staples to tech ratio. Staples is more defensive, and that's what people get into when they're more concerned the market's going to go down, because staples are things that you have to have no matter what's going on in the economy. Tech is the real growth area of the market. For going back to 2023, the staples sector was really underperforming tech. Well, lately we've seen a bounce. We came up to the 200-day moving average with this ratio. We were starting to decline, but then after Friday, we ticked back up. So we want this to decline for the market to stay positive. And we look at 1 to 3 month T-bills, which is pretty much cash, and we compare it to 3 to 7 year bonds. This ratio is still going up, even though it had been coming down. And I've been showing this in the daily videos. We want to see this continue to go down. That just means that interest rates and inflation aren't as big of a concern. Eventually, we want to see this drop below both of the moving averages. If this keeps going up, that's going to cause us some concern. And we're seeing that same basic theme here. 1 to 3 month bonds compared with 3 to 7 year bonds. We had been coming down, but longer term, we're still in an uptrend here. And kind of seeing that same thing. Tips, these are shorter term. They're adjusted for inflation. When folks are really concerned about inflation and interest rates, they get into tips because they're shorter term. They adjust for inflation. So you can just roll them into the next highest yield if we're going up with interest rates. Well, back in October of 2023, the market was just sure we were in a Goldilocks period and interest rates had topped out and were starting to come down. That's when we saw stocks really take off to the upside. So we saw this ratio really coming down. Well, now it's been going back up. However, lately it's been starting to come down. We want to see this ratio continue to fall and get below the moving averages. And home construction showing some improvement. For a while, it broke out above the rainbow. Now it's coming back down into the rainbow when compared to 3 to 7 year bonds. And this is a very highly interest rate sensitive area. This is also a concern. With the utilities doing quite well, we're seeing the S&P to utilities ratio going down. Usually when the S&P is outperforming, this ratio goes up, and you can see that's typically when the S&P goes up as well. We're also looking at the staples. When this ratio is going down, that means the S&P is outperforming. We want to see this ratio coming down. It started to go down, but now it's ticking back up. So we'll be keeping an eye on this one as well. And then this is the mass index, and I'm not quite sure what to make of this. I talked about it a week ago. I've been talking about it in the daily videos. The idea behind this indicator is that when you go above the red dashed line and then the blue line, that's part 1 and part 2. The signal is triggered when you come back down below the red dashed line. And whatever the market was doing before that and we were going up, this tries to suggest that we're going to reverse. Well, we haven't been doing that. And now we're getting further away from this indicator. And for right now, anyway, the S&P continues to go up. So this might have been a false signal. You can go back and look at other times when these signals were generated. It doesn't necessarily tell us the direction. It just suggests that things are going to reverse. Small caps been really frustrating in 2024. Yeah, we're going up here, but you can see we're right at the high end of the range that we've been in for all of 2024. We were really starting to shoot up going into December, and then we hit 2024, and bam, we've been going sideways ever since. If small caps could really start to thrive and go up, that typically will mean interest rates are going down because these are small companies and they have to borrow a lot of money, and higher interest rates dig into their earnings. If interest rates continue to fall, we might see some improvement here. But then when we do a ratio of small caps to the S&P, we can see that small caps continue to really underperform. They showed some signs of life back in November and December of 2023. Then we got into the new year and we've been just underperforming ever since then. So we want to see more confirmation. Just a breakout above these previous highs, that would not necessarily be enough. We want to see this ratio really turn and go up. Now, I personally don't involve myself with the small cap index, but I know a lot of people that watch these videos, they do. So that's why I want to hit this area. And the staple sector, this is, again, things that you have to have. And this has been in a really solid uptrend, and this typically ends up being more defensive. You can see how we were really going up into 2021 at the end, and then we got into 2022. And even though this chopped around, the staples held up a lot better than the rest of the market. Utilities, not setting an all-time high yet, but just screech into the upside right now. This tends to be more of a defensive area as well. So on one hand, this concerns us because these were the types of things that were happening right before we started to see the market really run into some problems. But on this next slide, this is Jason Gepfert. And years ago, he started a website called sentimenttrader.com. I really recommend, if you can afford it, to subscribe to his service. He came out with a study, and he put this on Twitter. I can't show his charts due to copyright issues. But when he puts it on Twitter, I feel it's okay to do that. And these are all the different sectors. Now, this was as of May 15th, so it's a few days old. It says stocks have been recovering since the April pullback. Yeah, but most indexes are still off their highs. Well, now they're not. At the time he posted this, we hadn't hit all-time highs yet from earlier in the year. Most sectors are too, except for two, the most defensive ones. Bears suggest that if staples and utilities lead the charge higher, this rally cannot be trusted. But historically, based on his research, the S&P 500 did just fine going forward. Over the next 6 to 12 months, there were only 2 losses out of 12 signals. So that's a pretty high percentage rate. So on one hand, yeah, we want to watch this because this is typically what happens when the market's setting itself up to go down. But based on his research, that doesn't necessarily mean the market is going to go down. Then I was also picking up on this 197-day cycle from the Perma-Bear video that I was watching, and this looked pretty good. Yeah, we see the top right here, hit that pretty right on. It hit the bottom right here on. It hit this top right at the beginning of 2022 right on. Didn't do so well going back a little further. Well, a week ago now, we hit another 190 days in this cycle, but we're continuing to go up. That's the problem with looking at cycles, is about the time you discover it is about the time it changes. So right now I have this on the negative side because the person that does this chart, they thought, oh, here we go. This is it. This is the main thing that we're looking at. This is pure gold. The market's just going to turn and go down 50, 70, 80%. Well, not yet. Hasn't done that, at least to this point. And we want to keep an eye on the dollar. It has been pulling back lately, which has been giving support to stocks. It is still in an uptrend on the daily chart. So, and it had been up in the 106 area. Now we're getting into the 104 range now. If this can continue to fall, that may help support stocks. Thank you. I really hope you found this helpful. I hope that you see some of the other videos that I post. I will be updating these and other charts in the daily videos. I hope you have a really, really good weekend, and I will talk to you in the next video.